Welcome back to Be Good Economics. This is Nate. Today we're going to talk about monetary systems, inflationary and deflationary. We're going to talk about the incentives upon those economies and a couple of historic events where different types of responses have occurred. Now, the inflationary economic model, or the monetary system we're going to talk about, is going to be based off of a Keynesian type approach, where you're going to inflate the currency supply in order to avoid massive deflationary events. The standard or limited supply is going to be under the assumption that we have a very fixed supply of currency. It's either going to only expand with the population or it's not going to expand at all. So one's a deflationary currency or limited supply currency, and the other one is a centrally controlled currency. So we'll talk about John Maynard Keynes. We'll talk about the history of these currency systems and what the positive and negative drawbacks and what we can kind of view of what we can expect on the incentives in these systems. So to lay out some ground rules, price inflation and deflation are revaluation of assets, okay? What do I mean when I say that? I'm saying that it is a redistribution of value. That means that if there is something that someone values a lot, or everyone values a lot of people want it, it's very high demand, and something that people value very little, very low demand. Deflation may cause both of these prices to go down. However, one can fall more than the other, which means that you've revalued this higher. So this can buy more units of this when previously this could buy more units of this, right? So all it is a redistribution of valuation. Price inflation is the same thing, but inverse. Asset prices go up and the value of other assets doesn't go up by comparison, but such as like labor. Labor may not keep up with inflation and therefore you're falling behind on your income, but the valuation of assets continues to appreciate. So let's look at some of the core incentives behind how these usually function. So price inflation favors asset holders. Price inflation favors debtors. If you owe money and you're getting a rate of change that is higher than the interest rate you owe, technically, you are paying off your debt faster. On top of that, if the assets you hold and your income raises, but the debt you owe doesn't raise, you are actually reducing the amount that you owe. So owing money and holding assets is better in an inflationary monetary system. In a price deflationary system, it favors savers and it favors wage earners because people who denominate everything in the currency benefit more than the asset holders who have a price dropping in the asset, but the wage earners are receiving the currency supply, which is constantly becoming rarer and rarer, or at least is limited, right? Wage earners are getting that advantage as well as savers who wait for prices to go down. Now, both of these systems are completely capable of experiencing inflationary and deflationary gaps. Both of these systems have a history of doing it, and they can experience inflation and deflationary spirals. You can watch my other video about inflation and deflation spirals and some of the myths about how they're infinite and how they are actually limited and they do stop, and how they both can exist in different types of monetary systems. So here is let's let the camera catch that one real quick. Here is a inflationary gap and deflationary gap. So an inflationary gap is where the productivity of a society is higher than what it is normally capable of sustaining over time. What do I mean by that? I am producing more than I normally can sustain. Now, since it's unsustainable, it is a gap. I am producing more than I normally can sustain with the economy. People are getting overtime, wages are going up, the productivity is going up. A deflationary gap is where the productivity is below what the economy can support. I can produce 100 units, but I'm only producing 90. I have a 10% gap in my productivity. Wages are going down, prices are going down, and so that can sound bad, but a deflationary gap is meeting what the economy can handle at the time as opposed to its total max productive output over time. So this idea that there is an ideal range does exist, but measuring it is very hard. So gaps are generally a broad conversation, and it's very hard to really show exactly what that gap may be. Now, as I said, they exist in both inflationary and deflationary currencies. Here is Ford's production of vehicles in the green rising line, and the red line is the price of vehicles falling. So you see that the price of the vehicle went from almost $1,000 down to $400, $300, while it's almost an inverse correlation in the productivity. So it's basically a supply and demand curve. More supply and either less or supply outpacing demand means lower prices. Now, something to note here, in 1925, we had a minor recession. What generally struck that recession in 1925? It was an inflationary gap. So inflationary gaps can also lead to, even in a limited monetary supply system, an inflationary gap can lead to a deflationary gap because you've overproduced and now there's excess supply. And so then all of a sudden the productivity drops off while you kind of wait. And so you suddenly there's underemployment and then you go through a deflationary gap. 1925 only lasted, that mini recession only lasted about a year and a half. And then over here is tractor production. Now, an interesting fact, the 1929 stock market bubble was very much fueled by speculation on tractors because they thought, hey, the United States is a very agricultural country. We've been an agricultural producer for the world for about 110 years. Why not just assume that this is a great advent, we're going to increase our productivity overall? And they were right. But the purchasing of tractors got so insane that the productivity just was going way over. People were buying tractors that didn't need tractors. Like people were using them for weird things. They were just all over the place. So tractor productivity just skyrocketed as the speculation went, hit that deflationary gap, 1924, 1925 range, and then went back up again and then dropped in the Great Depression. Now, we came out with a way to inflate our monetary supply in the 1920s, in the 1930s, we confiscated gold. So the money supply recirculated, we revalued it at $35 instead of $20. And so then we created an inflationary gap eventually over time. Now, part of that is the economy had to recover because the deflationary spiral wouldn't go on forever. But at the same time, we were increasing the money supply. So people stopped being able to save as much because they were now having to pay attention to an inflationary spiral that was occurring. Both of these systems obviously have inflationary and deflationary gaps that occur. And so we're going to go over deflationary gaps in more detail. Here is the United States in 2020. And you know why we went through a deflationary gap. It wasn't necessarily a deflationary spiral. There were job losses and things like that, wage changes, but a deflationary gap in 2020 because we all had to shut down for a period of time and there was a lot of fear. There was also one in the global financial crisis in 2008. These deflationary gaps were basically demand fell, and so productivity fell, and it set into a spiral. The global financial crisis was a spiral, while this was a gap. So we can see that they exist even in an inflationary monetary system because there's a delayed response to creating the money supply, as well as how much of that incentive really affects the total economy. Now, these other three charts here, because there's a rather controversial topic I'm going to bring up because it always triggers some people to have an issue with it, but I want to bring it up because I very much think that there's enough evidence here to talk this one pretty fairly. This is the Soviet Union. You can see why I'm like, oh, this one's always so controversial, because there's always other political conversations people want to have. They want to blame things like starvation on the United States and plague and stuff like that. The period I'm going to talk about, there's no plague. There's a drought later on that's probably caused by the lowering productivity of the grains and agriculture. And so the agroprom was started by Gorbachev in 1972 in order to increase productivity because he's blaming speculators from the blocks to the west that they were hoarding grain. This may or may not have been a political move to just try to shift blame because productivity was falling. So he increased productivity by stimulating the economy by putting a lot of money towards capital expenditure towards agriculture. And you can see by expenditure per agriculture unit as a percentage increased drastically. Now, the 1970s was a global period of inflationary monetary systems. This was across the entire world. So we can see that the input of currency does not really match the output because we go over here and we see a spike trying to play catch up and then it falls off in the late 70s. We get into a deflationary gap and we are producing approximately 10% less, 10 to 20% less grain in agriculture than is demanded. And when we follow this trend line, this diamond pattern line here, that is the rest of the world's agricultural productivity. But the USSR fell off a little bit of a cliff. Now, 1984 was a drought, but you can see that the gap started long before that. And if he started the agroprom because he believed that people were hoarding grains and we weren't producing enough, this is their numbers, right? So they don't claim that they're having a shortage, but if they claim that they're having a shortage over here, then obviously they're having a shortage. So what's happening, right? So there's not enough productivity to go around. So the claim is that there's not enough productivity going around, even though they claim the productivity stayed online with their data. And then they have this gap. Now, I'd argue that this gap is not really a gap as much as it is a spiral over the next 10 years, because in 1990, they came off, the USSR shut down, and there was a really big spiral. And that spiral was mainly that, one, the government shut down, which was a huge producer in GDP and agriculture because they incentivized everyone. and everyone had to come back in and fix it. But part of that spiral was also, they probably came out with their accurate numbers and showed you, like, as part of the result of the Cold War, give it to them on that end. You don't want to tell people you're having real problems because it shows a sign of weakness. But ultimately, the supply or the productivity fell off a cliff, and ultimately that gap was perpetuated by poor incentives. And so when we look at what their economists said in the late 80s, before the USSR even fell, what they were finding is that farmers were producing to keep it so that the inspectors would look on the outside and they count the rows and columns of the stalks of grain. 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Okay, there's 25 units inside that area, right? Wrong. If you're incentivized by the count on the outside, you make the inside more bald. So you start to get a little balding pattern in the middle of your farm, but nobody notices because nobody's flying overhead and checking, like, what's the grain production, right? So what's happening here is a realization that the incentives are not matching. You're increasing the currency stimulus, but you're decreasing the actual productivity, which means that the inflation is actually affecting these farmers, and they'd rather just be less productive in order to get enough currency for their time, because that there's a recession occurring. And so we can see that GDP per capita started to continue to decline even into this period in the 1970s and 1980s. And then it fell off the cliff when the USSR fell, and GDP is a measure of also government spending, and 100% of their economy is government spending. So you can see that in an inflationary monetary system where the government is spending into the real economy to incentivize activity, it doesn't always work because you can misprice the value of people's labor. So again, reviewing inflationary and deflationary spirals, inflation or wage price spirals are demand for higher wages and increase in consumer spending and higher costs, and it continues on. But as I said, there's always a bottom or a top, and the only thing that causes an inflationary spiral to be infinite is an infinite spiral of currency. So you can cut that off by stopping the currency supply. You can't kill the velocity necessarily unless that's a psychological function, but you can kill the excess currency supply, which would cause it to have an end eventually. Same thing for a deflationary spiral. It's not infinite. It may feed or revalue things outside of your country and feel infinite, but it's not globally infinite. So you may be exporting that currency to import until you basically go into complete failure, like Spain did in the 1700s, where they had the most gold in the world, and then in 100 years they had the least gold out of all the other empires. So these both can happen in limited supply and inflationary currencies. These spirals are a definition, again, reminder, they are a definition of the activity that occurs, but they are not inherently infinite. And so what does this generally do? So we compare the two currency supplies. So one thing people generally talk about is if you have a deflationary currency, you're going to hoard it. Let's say you have a limited supply. Your goal is just to have a bed of money, right? Because it's always going to go up in value. And the more I hold, the more value I gain, right? And you get Scrooge McDuck greedy people who are diving in, which interesting note here. Scrooge McDuck never dove into a pile of gold until 1982. Which is after the gold boom in the 1970s. So it kind of shows you a cultural thing. Before, he was always using cash. He was always floating around cash. He was throwing it, or it was following around. They had the Christmas Carol, Mickey's Christmas Carol, and Scrooge McDuck started diving into gold as gold started to be a symbolic thing culturally to the people that actually meant real wealth, because the speculative bubble into gold. So it's kind of like if he dove into Bitcoin today. This idea that that's what wealth is. You know, the same thing here. We don't even know what to do with all this money. It's just so much excess, right? But the idea that the economy or the people will just hoard money is false, because the spirals are not infinite. And so eventually there's something else that benefits you. Let's use an example. I invest in Bitcoin. I also invest in Ethereum. Ethereum is more volatile than Bitcoin. Why would I go further out on the risk curve for Ethereum? Because the potential for gains is greater. But I will not allocate most of my wealth to Ethereum versus Bitcoin, because Bitcoin has a safer bet. So part of this idea that you save money and hoard it, when you increase the value of the currency, inevitably you will go spend it because everything else gets cheaper. And there's things that you want. You won't just hold it forever. And you holding it is increasing the value for everybody else. So Scrooge McDuck might have this big vault of gold, but guess what? Gold is now rare everywhere else, which means that everybody else who holds gold is now a little bit richer in the things that they can purchase. Now, inflationary monetary systems can lead to an excess supply of currency. Now, both of them historically, for 2,000 years, we've had businesses and banks that were too big to fail. We had people, we had governments, and we had banks come in and bail each other out of these problems they were having for deflationary spirals because of activities that they either incentivized or occurred due to speculation or war. And they said, we can't let this fail, so they inflated the currency supply. Don't get it confused. These can both exist in an inflationary and deflationary currency. And I'm going to talk a little more about why. So first off, you're going to get bubbles. Bubbles are going to exist. Bubble theorem does not go away just because of an inflationary monetary system. Now, inflationary monetary systems do feed our natural response. We want to see number go up. Psychologically, that's really healthy to us. We're like, oh, number go up, I have more, right? So when you see the number go up, it might even inspire more speculation, but it doesn't really matter because even in a deflationary currency, you have the business cycle where people take out leverage, they go through an inflationary gap, we speculate that it's going to go even further, and then the gap can't go any further, and then it goes down. So you have extreme overvaluation, extreme undervaluation, and a redistribution of that value. So that's a reminder from another video. And then this is how we can talk about how a deflationary currency can function. And so we're going to use an example. This is showing you that value comparative to other goods, this little line here, yellow being the value going up, red being the price going down, right? If the value is going up, it doesn't matter as long as you can purchase more goods and assets. So value is comparative to other goods and assets. If I have one thing of gold and I can buy more things with that thing of gold than I did before, I am more wealthy. It doesn't matter whether or not I have more of the gold coin. It matters what I can buy with it, right? So here's an example of how that can play out. A 5-year gap between your investment. One share is 10 grams of gold, and it pays a dividend of 5 centigrams of gold, right? 1 week's wage is also 10 grams of gold, so the share cost 10 grams of gold. A car costs 200 grams of gold, and a home costs 3 kilograms of gold, 3,000 grams, right? So that's the comparison at year 1. At year 5, in a deflationary monetary system, one share is now 9 grams. It's lost 10% of its price, right? And the total payment that it gives you. And its dividend is 4.5 centigrams, which is 10% less. And then a week's wage is also 9 grams. So they actually stay the same. The share is the same as a wage. And the car is 170 grams, so it's 15% less. And a home is 3.1 kilograms, so it's up 3%. The population maybe increased or the productivity of homes went down. Why does this matter and how do I make sense of it? Basically, if for 5 years you were receiving a dividend and then all of a sudden you stop receiving that dividend, you have more shares or more units of gold that you've been able to cycle back into this actually positively valuing stock. It is beating your wages by spending 1 week's wages to buy that, and then constantly having a income. So it incentivizes that I need to find something of value that's going to provide me a dividend. So even if it's not going to grow because the psychological price appreciation isn't there, I am actually earning more by holding that share. And then on top of it, things are getting cheaper. So it held its price, but the price of something productive, because machinery increased, is actually going to incentivize that things get cheaper. Now, in a deflationary monetary system, some weird things can happen. First off, people are always going to want to find a way to create money where it didn't exist, right? Like, this is a human nature problem. This is a greed problem. This is a goldsmith note. Goldsmiths would have 10 units of gold, and they would hand out 11 units or 12 units of these goldsmith notes, or 100 units. It doesn't really matter. Fractional reserve banking would occur, where even though the currency supply didn't increase, the reserve note or the promise of gold increased. And so this can still cause inflationary gaps and inflationary spirals, and the only way to realize what's gone on is to go back to the gold, which most economies throughout most of history have done, and they fixed their problem by going back to the limited supply standard. If they did something to go away from that, the next tragedy was usually, the next crash was usually caused by the speculation based around the fact that they didn't fix the problem to begin with. Here's an example of a company town. Now, the problem is that wages will fall eventually, but they will keep up with the price changes, and usually you can benefit because you have negotiating power in a deflationary currency supply, where now your employer has to lower your wages. How do employers get around this problem? They're going to be incentivized to do something like a company town. They're going to be incentivized to do something where they supplement your income in a way that makes you feel like as though you're getting better off than your income, and then they reduce the value in here more than anything else because this company town is actually worthless to anybody outside of the company. So it doesn't have a free market opportunity for you, and therefore it has a net negative, but it's benefit to the company. And so this system has occurred historically in a deflationary gap, and it's usually because it's incentivized by the prices of things are going down and our productivity is going down against how much our wages cost. So in order to keep the productivity up, we're going to try to find a way to supplement income of people by printing something. Let's say they print shares, and so they offer share offerings because they're like, this has value. If they don't produce a dividend, or the price of it doesn't at least hold its value, that's wrong, right? You're inflating a currency supply or another type of currency. On the same end of that, if you go to an inflationary currency, let's talk about 1 year gap. You have one share at $1,000. The dividend's $50 for same ratios. Week's wages $1,000 for same ratios. Cars $20,000, same ratios. Home is $300,000, same ratios, right? I took the same ratios and applied it. Now, 5 years later, one share is $1,300, so now there's a 30% increase because the monetary system is dedicated to protecting asset prices, right? So that gets speculated into. You're using fractional reserve lending. You're creating more currency supply, so that gets, oh, I got to protect my currency. I got to get out of the currency. Let me put it into the stocks. And so then the share goes up in value. The dividend goes up by about 10%. So the dividend, you're less incentivized to be really strong on the dividend because, hey, why would I need to pay a high dividend? The price is going up, right? And then the week's wages don't necessarily keep up because every time inflation spikes, your wages go a little bit down. And the wages don't really keep up because your wages might go up next, but you have a year to wait, and then you have to negotiate. And they may say, well, the inflation may not be here to stay, right? There's a fog that can kind of be used to hide your value. And then on top of it, you have the car growing by 15%, just as a general example. It kind of keeps up with wages, but it's also because commodity prices are going up, so it goes up too for its productivity. And homes, because they're also leveraged and people take out loans because the prices are constantly appreciating, go up by like 20%. And this is just a general example, and what we see in our current economy is this is some of the incentives of an inflationary monetary system. People can't save, so they have to go and invest their money, and as they do that, they cause a wage price spiral over the long term. And so it has an exponential curve in price against value. The value may go up or stay the same, but the price is going to rise no matter what, because ultimately we have to keep stepping in to keep things from falling. And so every time we do that, we also incentivize paper gains. We're more focused on stocks than we are real productivity. And we produce things that are mass units of supply meant to support this system. So instead of having much more individual and independent houses, or having apartments, we're building these models on, we have to sell you property, an asset, right? The focus is on selling you an asset rather than something you actually want. You're focused on something that or something that you would prefer. Instead, you're kind of convinced to sit in a system where, hey, these houses are produced in standard so that this way they're, one, affordable for production, and two, can be used as an investment asset. So it kind of financializes the entire economy. It makes things focused on the money supply rather than the productivity. So they both have their drawbacks, but this brings you back to my core model, the differences in a asset deflationary currency, and the asset deflationary currency system ultimately focuses on where the money is the reserve asset, the safe haven, and then so when a crash happens, the money goes up in value and the stocks go down, which means you can buy more stocks, and so you get more opportunity. In the inflationary supply system, it's on this infinite spiral of constantly fluctuating between monetary hedge assets to protect yourself from the crash, the bonds that are constantly going down in actual real value because you're not interested in holding it because the currency supply keeps being low in value. So you only go to it as a safe haven to protect yourself against the crash that's inevitable to occur in the stock market. But it will inevitably recover because they will pump it full of money, but that doesn't necessarily mean that the value increases. So that's my core thesis with that. Ultimately, we're on a series of choices. Economics is always a series of choices. It's decision-making based off of what you want and what you need out of your economy. If your economy needs an inflationary spiral to avoid the crashes, you might want to look at why, right? What is wrong with the crash? Is it because people are getting out of their assets? Is it because people are over-leveraging themselves? Is it because companies are over-leveraging themselves? Are you incentivizing more leverage in that system? On the same side, on a deflationary economic model, there's nothing we can do about a deflationary gap except try to incentivize people to invest and put their time and effort into being productive. But in order to do that, in order to get out of the gap, we have to figure out a way to incentivize it. So it's either looser regulations, which can be dangerous, or we have to increase the currency supply. We have to do something to incentivize spending. And so the way we don't necessarily have to do that, but you're going to suffer through a deflationary gap that may not recover for a period of time because of this issue. So just things to think about on inflationary and deflationary currencies. There are net negatives and net positives between the two. And I think that what they cause as incentives are worth acknowledging, that they both have incentives that are worth looking into and actually comparing in a fair sense. But that said, you can see that there's drawbacks to both. So Thanks for watching. My mouth is really dry after talking for 25 minutes, and I'm sure you're very bored. So have a great day. Enjoy yourself. I'll be back with more videos, hopefully shorter ones. So next time.